Buyers don't just take your numbers at face value. Before a deal closes, they bring in accountants to verify everything. And this is where many deals start to move. Sometimes the valuation drops, sometimes the structure changes, and sometimes the deal falls apart entirely. This process is called a quality of earnings review, and if you are planning to sell your business, you need to understand it. A quality of earnings review, often called a Q of E, is a detailed financial analysis carried out during due diligence. Its purpose is simple. The buyer wants to confirm that the earnings used to agree the valuation are real, sustainable, and supported by the underlying financials. You may have come across the term adjusted EBITDA. That is the number buyers use to value your business. But before they commit to that value, they want independent verification. So they bring in accounting firms or transaction specialists to review your numbers in detail. This goes far deeper than your annual accounts process or an audit. An audit focuses on whether your accounts are compliant. A quality of earnings review focuses on whether your earnings are real. Buyers are asking one core question. Can this business reliably generate the level of EBITDA that the valuation is based on? Buyers do this to reduce risk. When someone is investing significant capital, they need confidence in the numbers. Management accounts can include estimates, timing differences, or classifications that make performance look stronger than it really is. A Q of E review tests those assumptions. It reconciles management accounts to statutory accounts. It analyzes revenue and cost trends over time, and it challenges the adjustments used to calculate EBITDA. If the numbers hold up, the deal progresses. If they don't, the buyer will push back. First, they look at revenue. Not just how much revenue you generate, but how reliable it is. They analyze trends month by month and year by year. They look at customer concentration. They review contracts where possible. And they test whether revenue has been recognized in the correct period. If revenue has been pulled forward or is unlikely to repeat, it will be challenged. Next, they look at EBITDA adjustments. Every adjustment used to present adjusted EBITDA is tested. Non-recurring costs, owner compensation, and related party transactions are reviewed in detail. Buyers will ask for evidence, invoices, contracts, payroll records. If something is labeled as one-off, they will check whether it really is. If it appears more than once, it may not be treated as exceptional. This is where a lot of tension comes into deals. They also look at margins. Gross margin and operating margin are analyzed over time. If margins are stable, that builds confidence. If margins are volatile, buyers will want to understand why. It could be pricing pressure, rising costs, or inconsistencies in reporting. Another key area is working capital. Receivables, payables, and inventory are reviewed in detail. The goal is to understand how much capital is required to run the business on a normalized basis. This matters because it directly affects the cash the seller receives at completion. All of this analysis builds a clear picture of how the business actually performs. And this is where deals start to shift. If the quality of earnings review supports the adjusted EBITDA, the deal usually continues as planned. But if issues are found, the buyer will respond. If EBITDA is lower than expected, the valuation may be reduced. For example, if EBITDA was presented as $1 million, but the Q of E concludes the sustainable number is $800,000, that difference flows directly into value. At a 5x multiple, that is a $1 million reduction. Same business, different number. Sometimes the price does not change, but the structure does. Buyers may introduce earnouts, deferred consideration, or retention payments based on their findings. This is why preparation matters. The best way to protect value is to be ready before the process starts. Strong management accounts. Clear and well-supported EBITDA adjustments. Consistent financial reporting. These all help build credibility with buyers. Increasingly, sellers are commissioning their own quality of earnings review before going to market. This is known as a vendor Q of E. A quality of earnings review is not just an accounting exercise. It is one of the most important stages in selling a business. This is where buyers verify the numbers behind the valuation. If the earnings are strong and well supported, the deal moves forward. If they are not, The price, structure, or even the deal itself can change. Because in the end, buyers are not paying for reported profit. They are paying for verified, sustainable earnings. And the quality of earnings review is how they prove it. Like and subscribe for more content on business exits, valuation, and M&A insights.